Before we go any further into our discussion about investing, particularly investing in stocks, we should ask ourselves, what is a stock? Most small companies are owned by a single individual or maybe a family or a small number of people. However, when a company grows to be a certain size, at some point they start needing additional capital or money that they can use to invest in their business's operations so that their business can grow. Companies raise capital to fund their operations by selling shares of stock. When a company decides that it wants to go public, that means that they're going to start offering stocks for sale to the public on public stock exchanges, like the New York Stock Exchange. When companies sell stock, they're inviting investors to purchase a fractional ownership interest in the company, making the stock owners part owners of the business. Which means when you buy a stock, you're actually buying a small piece of the company. Equity is a word used to describe ownership, and equities is another term for stocks. Companies can also use bonds to raise capital, although buying bonds makes you a creditor without taking any ownership stake in the company. Buying a bond really means you're just loaning money to the company. When you buy shares of stock in a company, you get certain privileges depending on the type of shares you own, including voting rights, meaning you have the right to vote at the company's annual shareholder meetings, dividends, which means you may receive a share of the company's profits. We'll talk more about dividends in another video. And capital appreciation. Basically, when the company's stock price goes up, your shares increase in value. However, when the price declines, the value of your shares also falls. While stocks give you an ownership share in a company, owning shares of stock doesn't mean you're entitled to a say in the company's day-to-day operations. Owning a stock means that you trust the company's leaders to run the business in a way that will make the company profitable and successful in the long run. If you don't like the performance of a company, you sell your shares and you choose a new home for your investment dollars. One other common misconception about buying stocks is that when you buy stocks, you're investing in a company. That's not entirely true. When a company initially goes public or first starts offering shares for sale to the public, they do receive income from the sale of those shares. However, that only happens once. And from then on in, whenever you buy shares of a stock, you're actually buying them from some other individual. If you're buying shares, that means someone else, either another private party like you, or more likely some big bank, is selling that share to you. So, when you buy shares in Apple or Ford or Tesla, Apple, Ford, and Tesla do not receive the money that you pay. Someone else who is selling those shares to you will actually get that money. We can go more in depth on those sort of transactions later as well.